Hello, welcome back to my channel. Good to see you here. If I had $1 each time I get asked, what happens to my mortgage rate? Each time the Fed increases or decreases the Fed funds rate, I would be able to buy a new house. Just kidding. But I do get asked a lot, and the Fed just raised the Fed funds rate yesterday by 50 basis points. But what does that mean to you? Well, the Fed funds rate affects our entire economy, but it's important to note that it does not set the mortgage rate, but it will help you plan your finances in advance, so it will help to know how they all work. Do you want to know how it works? If you're unclear about all this, then sit back, relax, grab a glass of your favorite drink or a cup of coffee, and watch our video about how the Fed funds rate works, how it affects the mortgage rate, and more importantly, how it affects you in general, or as a home buyer or as a home seller. So let's get started. Before we start, as usual, if you appreciate videos like this, which takes a long time to put together, it would mean so much to me if you go ahead and hit that like button. And if you haven't already, go ahead and subscribe. More importantly though, make sure you click on that bell, because that bell is what gives you a notification each time that we upload a new video. And I know it's silly, it's annoying, but you will be helping this channel, and we can make more videos like this, as well as keep you updated in the current housing market. We'll do vlog tours of neighborhoods, of course do tips and advice for home buyers and home sellers. With all that said, thank you so much in advance, and let's get started. So here's what normally happens when I'm on the phone with a client. Hey Rico, the Fed just increased the rate by 50 basis points. Is the rate of my pre-approval going to go up? Well, my answer typically is, well, you need to talk to your lender and ask them what the current rate is today and see if you still qualify for the same amount. Then I go on to say that by the time that the Fed makes the decision, either increasing the rate or going down, the lenders have already priced all this in a few weeks before. The response typically is, huh? Before I explain, let's go ahead and talk about the Federal Reserve, or the Fed for short, and the Fed funds rate. So here's how it works. The federal funds rate is an important part of our economy. This rate is set by the Federal Reserve, or Fed, the Fed for short. It wants to keep the economy just right. So not too high, not too low. It's a balancing act. Whatever the Fed decides on the federal funds rate, the banks will then react by increasing or decreasing how much they charge each other for overnight borrowing, and then they pass it on to you. Nice of them, right? The rate also affects the cost of goods and services. The purpose of setting the Fed funds rate is to keep inflation at a manageable level and help keep prices of goods like groceries stable. Okay, so more on that later. Inflation is when the prices of goods and services go up. So you can't buy as much with the same amount of money. So it's like an ice cream that you usually pay $3 for, and all of a sudden you're paying $5. Inflation has happened to the cost of that ice cream. So mostly inflation just means everything is becoming a little more expensive, but sometimes inflation can happen fast and cause prices to double or triple over a short period of time. So inflation affects almost everyone in different ways. So it's important to understand what inflation is and how it can affect you. Again, inflation affects how much items cost and how much services cost. So this is when the Fed comes in. If there's too much money in circulation, then money will be worth less and prices of goods will go up. And this is when the Fed will step in. By raising the Fed funds rate, it will lead to fewer people borrowing because it's more expensive to borrow, and so they spend less money. So when people spend less money, then inflation starts to reduce a little bit and will help keep the prices of goods and services from rising too much. The Fed funds rate also affects other economic factors like employment and the performance of the stock market. When the Fed funds rate is low, it's cheaper for businesses to borrow so they can grow their business. So when they grow their business, it will mean hiring more people, so they're creating more jobs. It also affects the stock market. Higher Fed funds rate means lower stock market performance because investors worry about the reduced economic growth. The economy slows down each time the cost of borrowing gets expensive, which means it's more expensive for businesses to do business. Do you see the balancing act that the Fed has to do here? It's like a doctor trying to figure out if they should give you more or less medicine to get you just right. The Fed meets 8 times a year, and they go over all the numbers to see if they can stimulate or slow down the economy, and they have a target of having the inflation rate around 2%. For a while there, we were well below 2%, which was great. But do you know what the inflation rate is now? It's 7.1%. Ouch. I'm sure you've felt it in your grocery bills as well as anything else that you're buying. The Fed also uses the federal funds rate to balance spending with savings. When rates are low, it encourages people to spend more rather than save because they get more bang for their buck. If they were to save and the interest rate on savings are low, well, why not go ahead and spend the money since things are cheap? The more they spend, the better the economy and the more money is circulating. But the Fed doesn't want too much money circulating. So they'll increase the Fed funds rate up a bit and continue to tweak the rate until a more balanced economy. In general, setting the federal funds rate helps promote economic stability by controlling inflation and also balancing the spending with savings, so that in order to maintain these goals effectively, it's important that you, the businesses, as well as financial institutions, to know exactly what happens when the Fed funds rate. So, and it's important to you, and you should really keep an eye on it. This way, you can make an informed decision about your finances. The Fed does a lot more to keep the economy balanced, like buying securities to get more money in circulation. But we'll stick to the basics for now. Let's quickly talk about mortgage rates and how the Fed funds rate affects the mortgage rate. Now, a mortgage rate is important because it affects how much you have to pay for your loan. So when deciding on a mortgage, it's important to understand how a mortgage rates are determined and what affects the cost of your loan. And the mortgage rate you see advertised or get when getting a pre-approval for a loan is determined by the 10-year Treasury note. And this is based on the 10-year Treasury notes which are issued by the federal government. The 10-year Treasury notes yield reflects how investors feel on how well or how they expect the economy will be doing in the near future. And the yield is the earnings that the security generates. So higher yields indicate that investors think that the economy will be strong in the near future. And of course, the opposite is true. When the yield is low, the investors think the economy will be weaker in the near future. When investors are more optimistic about the economy, they tend to buy more securities and drive up the price. When the price goes up, then the yields are lower and the mortgage rates decline. So a better explanation is when there's good news in the economy, then the stock market typically goes up. So more investors want to buy more stocks. Unfortunately, most investors, when they buy stocks, they have to pull that money from their bonds. When they do that, bonds will go down. And as bonds go down, then the bonds have to increase their yield or interest in order for them to attract the investors back. And when the interest yield goes up, then the mortgage rate also goes up. So typically the stock market and the mortgage rate kind of go hand in hand, as well as inflation. And the opposite is true. When one goes down, all the rest goes down as well. Not all the time, but most of the time they do move in the same direction. Confused yet? Me too. Just kidding. The Fed funds rate is a crucial indicator of the health of our economy. And the Federal Reserve Board uses it to influence economic activity, like controlling inflation, cost of goods, and employment. Now, the Fed funds rate affects the mortgage rate in many ways, but it's important to know that it does not determine the mortgage rate. So how does the Fed funds rate affect the mortgage rate? When the Fed funds rate goes up, the cost that banks charge each other for overnight borrowing goes up as well, and then they pass it on to you. Now, the Fed does a lot of media talk, and they normally do this 2 to 3 weeks ahead of their next meeting. So when the lenders hear these hints during their media talk, they will price it in accordingly in their rates. So by the time the Fed actually make a decision 2 or 3 weeks later during their meetings, that's already priced in the mortgage rate. So most of the time, it doesn't affect the mortgage rate when they make the decision, and normally you won't see much change in your interest rate. However, if they do make a decision that's different from what they were hinting, then of course at that point the lenders will act accordingly. So how does this affect you as a home buyer? Get to know the 8 dates that the Fed will meet throughout the year. This way you can also watch the news well in advance and see what kind of hint that the Fed is giving you and see how it affects your buying power. The more you know, the better you'll be able to plan ahead. So make sure you meet with your real estate professional as well as your lender for sure, and have them help you, guide you through this crazy times. So depending on where you are in your buying process, it might be a good time for you to lock or not. But knowing what to do or knowing how it all works and affects you will definitely help you plan ahead. And how does this affect you as a home seller? Well, I would still get to know the 8 dates that the Fed will meet. That way you'll know in advance by watching the news also if it's a good time for you to sell or not. And if you do have to sell, make sure you meet with a great experienced real estate professional who knows how to guide you in this type of market and help you price your home well so it will sell quicker and not stay in the market longer than it should. Now, we've only covered the surface of how the Fed affects our entire economy, how it affects the mortgage rates, but if we go any deeper, it'll make this video a lot longer. So if you want to comment anything, have any questions, or just want to mention something about the entire video or even how the Fed affects the rate and the economy, I would love to hear from you. Go ahead and comment below or reach out to us if you have any questions. And if you want to know the current state of the housing market, then watch this video next. And with that said, we'll see you around town.